When you look at the country and consider the events that have unfolded in the last 25 years, you'll immediately realize that we are currently experiencing one of the most unique and perilous periods in American history. From an economic standpoint, the United States has largely avoided a significant recession since 2010, fostering a period of remarkable employment and low interest rates that have influenced the collective mindset from Wall Street to Main Street. This prolonged period of prosperity has somewhat blurred the memory of economic hardships to some extent. However, disturbing developments are emerging in various industries, indicating a worrisome and troubled future. Before any recession or depression, there are consistent signs that herald the impending economic turmoil and provide early indicators of the challenges ahead before impacting the entire country. This phenomenon is often likened to a canary in a coal mine, where a specific industry or indicator serves as a predictive precursor, offering a glimpse into what lies ahead. One of these canaries is likely something you see every day, but probably never thought about: the trucking industry. Trucking, or freight transportation as it's often referred to, is one of the most interesting examples of this. When there's a downturn in freight transportation, it is often followed by a macroeconomic downturn. For instance, in July of 1990, the world of trucking experienced a significant slowdown. Soon after, home prices in the Los Angeles market began to plummet. The Los Angeles market experienced a decline of over 27% over a 6-year period. Values in some upscale neighborhoods dropped by over 50%, all reported to have occurred shortly after the onset of the trucking downturn. Fast forward a decade to March of 2000, another trucking downturn gripped the nation, followed by the burst of the technology bubble. The NASDAQ index, tracking some of the world's largest technology companies, plummeted by over 78% from its peak in March 2000 to its trough in 2002. While this downturn didn't heavily impact the housing market, it had significant repercussions for the overall economy. Unemployment soared for years and many companies went bankrupt. Even giants we know today, like Amazon, experienced incredible drops, nearly plummeting by 95% from peak to trough. Then, of course, we experienced the trucking downturn in April 2006, heralding the onset of the Great Recession, the largest housing collapse in modern American history. From August 2006 to February 2012, housing prices in the United States dropped by approximately 30%, with more severe implications in some overheated markets. In fact, this industry has often served as an early indicator of broader economic downturns. When a crisis hits, the rest of the economy tends to follow suit. And today, as I speak, the trucking industry is experiencing one of its worst downturns in history. While not prominent in the rest of the economy, freight transportation is in panic mode. Over the past few months, various bankruptcies have surfaced in the sector. It all started with Yellow Company. Yellow was a transportation company founded in 1929. It had seen it all: dozens of economic downturns, wars, and everything else that occurred in the past 90 years in the United States. Despite its performance history, it filed for Chapter 11 bankruptcy in August. This closure, which included over 30,000 employees and over 12,000 trucks, was a massive shock to the entire industry. From here, the industry would continue to spiral. Convoy, a Seattle-based digital carrier backed by Jeff Bezos, shut down in October just 18 months ago. The business was valued at nearly $4 billion. According to a memo sent to employees, the CEO Dan Lewis stated that the company faced both an unprecedented freight market collapse and a dramatic monetary tightening. And he wasn't alone in this newfound environment. Dozens of operators would continue to file for bankruptcies in the weeks to pass. Surge Transportation, a broker with $200 million in revenue, filed for Chapter 11. Freightworks, a North Carolina-based trucking company with over 140 drivers, ceased operations. Certified Freight Logistics in California shut down, putting over 150 drivers out of work overnight. The list goes on and on. You can read about all the big ones by following Craig Fuller on Twitter. He has a thread with some of the biggest names that have faltered recently, and as you can see, it's pretty endless. In summary, trucking is in trouble. Now the question is, will this issue spill over into other sectors as it has in the past? To answer this question, we can look to the ultimate evidence that reliably predicted the last 8 downturns in the United States. When combined with what I've just explained, it truly calls into question the future economic outlook of the United States. Now, before we delve deeper into this topic, if you found the content intriguing so far, I'd greatly appreciate it if you could take just 2 seconds to hit the like and subscribe buttons. Every like significantly strengthens this channel, and your support means the world to me. Thank you. Now, getting back to our main point, what we're looking at here is the yield curve. You've probably heard references to it countless times, but right now the yield curve is both intriguing and unsettling from an economic perspective. Typically, when the yield curve inverts, it signals troubled waters ahead in the coming period. I won't get into the technical details of what the yield curve entails, but remember this: when it dips below a certain threshold, it often heralds economic difficulties. What further piques interest is that these difficulties often emerge after the yield curve has reversed course and started trending back towards normalcy. And today we find ourselves at that juncture. The yield curve inverted months ago and is now slowly inching back towards healthier levels. Historically, this stage signals the onset of economic pain. In the last recession, after exhibiting this behavior, the yield curve witnessed significant turmoil. Similarly, today we're witnessing similar patterns. For instance, in 2008, the yield curve nearly normalized before the recession fully manifested. It inverted in 2006 and corrected in 2007. The impact of the economic downturn was truly felt when the curve almost returned to expected levels. This mirrors current trends in the bond market. The yield curve dipped significantly below zero in the summer of 2022, reaching unprecedented levels since the 1980s. Typically, experts gauge the severity of an impending recession by the depth of this decline. Given this drop, the outlook appears rather bleak. As the year draws to a close, we find ourselves in the early stages of recovery with a clear sense of concern about the future. As in previous events, it may take some time for any warning signs to emerge. As mentioned earlier, the curve can normalize before any trouble arises. When you consider events in other leading industries like trucking, the situation looks even more dire. The decline in freight activities indicates diminishing consumer demand and reduced economic uncertainty. With the inversion of the yield curve and short-term interest rates surpassing long-term rates, the situation appears increasingly worrisome. Inverted rates signal a lack of confidence in the near-term economic outlook. These combined factors serve as warning signs of a potential economic downturn, indicating weakening economic conditions and the looming threat of recession. While most industries in the United States have yet to witness significant declines, a closer look reveals that all is not well. The future remains uncertain, with a massive question mark looming overhead. As always, thank you for tuning in. If you found the content valuable, please don't forget to hit the like and subscribe buttons. And especially if you're part of the trucking community, remember to share your observations in the comments below. Your insights are invaluable.